Welcome to the San Antonio Housing Market Update, September 2024. I'm your host, Krishna Perkins, and today I want to start off this report by sharing two articles that I thought were interesting and what they might mean for the broader real estate market and how they would relate to the San Antonio housing market, and also one piece of data from the St. Louis Fed. And really, I always like to look at these things because especially since 2007 when I started in real estate, because it always seems to be that San Antonio follows the rest of the real estate market in general countrywide, because we tend to be on the receiving end of more people moving to San Antonio, especially over the last several years. But it's always very telling to look at headlines and then see what's happening in San Antonio, and then months later see what's happening in San Antonio and how closely related some of those headlines are. So I want to share a couple of headlines here real quick and then get into the local market report for San Antonio. So this first one from CNBC, Jessica Dickler, key points here she makes. For months, there's been a vibe session that's a disconnect between how well the economy is doing and how people feel about their financial standing. It's definitely been very confusing. A lot of different headlines out there. People are trying to predict recession. Now, recent economic data and consumer sentiment are more in line, some experts say. The problem with the recession is, of course, they will always, at some point, be right, says Brett House, economics professor at Columbia Business School, which very true. You could just say someone's going to have a car crash over and over every day, and of course, someone's going to be having a car crash. It goes on to say, for months, economists have wrestled with the disconnect between how well the economy is doing and how badly people feel about their financial standing. Now, evidence suggests that the so-called vibe session, or the prolonged period of negative sentiment about the economy, appears to be ending, according to Michael Pierce, deputy chief of the U.S. economist at Oxford Economics. As inflation cools, the Federal Reserve prepares to lower interest rates. Americans' assessment of the future are improving, which is bringing the country's economic standing more in line with consumer sentiment, Pierce wrote in a report published Friday. So very good article here. Check that one out. I think it's very telling on where we're heading and potentially how that's going to affect the real estate market. The second article, also from CNBC, from Robert Frank, says sales of $10 million homes surge in Palm Beach and New York. New York led the U.S. in the number of homes sold for $10 million or more, with 72, its highest total in 2 years, according to the real estate firm Knight Frank. And then the biggest sale of the quarter was the $150 million deal for Palm Beach's only private island, which was reportedly purchased by Australian infrastructure investor Michael Doro. So this is another really good article. It's not all positive, because there are still $1 million properties out there that are not getting sold and that have taken declines in different markets. But the overall theme of this article suggests that the real estate market in the ultra luxury realm is doing very well. People are making moves. People are buying and selling in the luxury markets, primarily based on the economic data that they are consuming and relying on. And then finally, the home value, equity, and debt information from the St. Louis Fed. Now, this is very interesting because we're always drawing parallels today to the 2008-2009 crisis. And if we look really close at this chart here from the St. Louis Fed, we look at the from 2007 or 2008 all the way through 2012. We're looking at three lines here: owner's equity in blue, that's this middle line here, and then home mortgage liability, so your mortgages, and then real estate values, okay, on the green line. And you notice here that home mortgage liability and owner's equity crossed at 2008. Okay, this is when we became just underwater, where we had more debt than the properties were, and the owners that had equity in them. So they were borrowing over 100% of the property's values, okay, because we got really risky with the loans there. But that ended in 2012 when banks began to make better loans, in short. And as you can see, we continue to have a divide between home mortgage liability and owner's equity, all in a positive direction. So less reliance on mortgages up through today, bigger down payments, and owner's equity here. So where we are today, where we were in 2008 through 2012, light years were the difference. This just shows that we're in a quite a different position right now. It doesn't mean that things can't go wrong in the future or they won't go wrong in the future, but we're certainly in a different position than we have been in the past. Now, getting to the San Antonio housing market numbers here, as you've been waiting for, we are still slightly in a seller's market. Now, we have been inching closer and closer to this balanced market, which frankly, some areas of San Antonio, some neighborhoods, and particularly some suburban areas are in either a balanced market or even a buyer's market. So we're going to get to that in a separate video, but we're still inching closer to a balanced market in San Antonio. In fact, we are up almost 2% month over month in inventory. So we have almost 2% more inventory than we had the previous month. Okay, this is for August. List to sold price ratio, homes on average there are selling for about 98% of the list price, okay, the ones that have sold. The number of days on market has increased about 10%. That's there about 34 days on the market typically. And the median price sold, or typical height price the homes are selling at, is at $298,000. That's actually down about 2% from the month before. The median estimated property values for San Antonio, home values came in at a median estimated value of $284,140. And that is a change of about increase of 0.8%. So almost 1 point increase in estimated property values. And over the last 12 months, down 2.3%. Now, I attribute this gain this last month to potentially to the drop in interest rates that we've seen. We haven't even had the official interest rate drops or interest rate cuts yet. The market is just, they bake that in before it even happens based on the data that they have and the confidence that the Fed is actually going to drop rates, and that will affect the markets moving forward. And now, newly listed homes in San Antonio, the typical list price for homes listed in August came in at $295,000. That's actually down 4.5%. So the newly listed homes are coming in cheaper. So sellers are getting aggressive there, pricing their homes when they're bringing it to the market. Also, the number of homes listed going on to the market came in at 2,541 properties. That's actually down almost 10%. So we're seeing 10% fewer properties listed in August. This is actually very normal seasonally. If you're looking at this graph here at the bottom, every year you see we have a spike and then we have a dip. We have a spike and we have a dip. We are on our downward trajectory for the year 2024 in newly listed homes here in San Antonio. So this is not anything out of character for San Antonio, perfectly normal. The typical living size of these newly listed homes is coming in at 1,748 square feet. If we look historically, much the same, okay? Smaller homes getting listed towards the end of the year versus the larger homes. Active listings, this is where all of our inventory over the past couple of years that has risen is coming from. Active listings, the median list price is actually down slightly, and it's down to $310,835. The number of properties that are remaining active on the market is just barely up. It's almost zero number of properties, 7,564 properties. So we do have a lot more properties than we had in the last few years available, and even pre-pandemic available. So we'll see how that goes and what the interest rate does to that, because we are seeing a flattening of the number of properties that are just active on the market. So if rates do drop significantly, we could see buyers rush in and purchase some of these active listings, because right now they're either not priced properly or maybe they need too many repairs. Just depends on what the situation is. New pending listings, buying activity did slow, and it slows every year towards the end of the year. The typical price for homes going under contract is $294,000. That's down 2% from the previous month. And the number of properties that went under contract newly pending is down almost 14%, 1,433 properties in the pending status now. The number of days on the market, those pending status homes came in at 442 days on the market. And then for pending listings for the month of August, also down 3.1% in price. That's $299,999. And the number of properties sold or that went into pending status also down 11.3% for 1,866 properties. And again, we are on a downward trajectory. We're seeing fewer homes continue. I chalk this up to the interest rates finally taking hold of the market. And this is why you're looking at the Fed cutting rates, because real estate is such a powerful driver of the economy. And as you can see, they have done their job in bringing the number of pending transactions down. If you look here back to 2019, we're just over the 2,000 transaction part, 2,340 transactions or pending listings, and we're almost dead even there. So the timing of cutting interest rates is just really spot on. And then sold listings, homes sold in San Antonio. The typical home sold for $298,000. That's down 2.1% month over month. The number of properties sold in August is also down about 16.5% for 1,417 properties. And looking back at the data again, you see here we are we're right below 2019 sales. So sales definitely have been affected, and this is a key indicator. This is definitely something to look out for, and this is also why the Fed is choosing now, in my opinion, to begin to look at cutting interest rates. So I would expect we'll see more activity as the rates actually do come down over the next few months. And so wrapping that up, we come in at 4.64 months worth of supply here in San Antonio. Last month, we saw a 2% increase in supply. And over the last 12 months, we've seen a 30% increase in supply. So we're definitely in really a transition phase here in the San Antonio housing market. How effective the interest rate cuts are to be determined. We'll see how that work plays out. I know that I felt like last month there was a definite increase as rates fell. We had that small stock market correction and interest rates fell. Lots of buying activity I noticed in the housing market here in San Antonio. And we're going to continue, I think, to see that happen in different neighborhoods where people have been watching homes and just sitting back and waiting. And when their loan officer lets them know that they've received some really great rates, they jump into the market. So if you have any questions, you're thinking about making that move, give me a call, 210-260-6617. Be happy to discuss all your options. And until next time, see you.